From 11FS, this is Fintech Insider News, and I am your host, David Barton-Grimley, Strategy Director at 11FS. Thanks for downloading this podcast. If you like what you hear, why not recommend it to a friend? This week, we are talking digital wallet Paze is coming to the US. Paze is jointly owned by 7 of the largest banks in the US, including Bank of America, Wells Fargo, and JP Morgan Chase, and it is yet another digital wallet challenger in the US. Very competitive landscape. We go into a lot of detail trying to figure out whether or not there is a market here and how Paze is going to make money. Secondly, Railsr is making a big comeback after announcing £20 million of funding. That's right, Railsr is back. They've been resurrected, and we discuss where the market is for them. Where do they go from here? They've really struggled. I think most of us know Railsr's story. It's definitely been a roller coaster. So what does this new funding enable, and can they actually make it? And finally, we discuss, because it's Halloween, what fintech would you bring back from the dead? Lots of different ideas shared on our LinkedIn channel and lots of fun tidbits from our panel. We get into all this and much more on today's show. Back after these messages.
Commercial banking is changing faster than many banks can keep pace with. The innovation that's been unleashed by digital technologies and fintechs has transformed what commercial banking looks like today. In our brand new report, in association with Infosys Finacle, we explore the new generation of commercial banking, how value chains are being transformed, and what banks need to do to thrive in this new ecosystem. A must-read report for anyone in commercial banking, we combine our insights with those of 14 thought leaders from across financial services to break down the current situation, the catalysts of change, and what impact it will have on the industry. Don't miss out. Download your copy today at 11fs.com/commercial banking. Hello and welcome,
LFG people,
to Fintech Insider,
Blockchain Insider, 11FS Spotlight,
11FS Explores,
Open Mic Night,
After Dark. Through our podcasts, videos, newsletters, and live events, we have a direct line to a truly global fintech community. So if you're looking to sponsor and collaborate on content that connects with everybody from fintech beginners to the biggest VCs, then chat to our team at sponsors@11fs.com or visit 11fs.com to find out more.
Long live the community.
Hello and welcome to our landmark 800th episode of Fintech Insider. I'm David Barton-Grimley, Strategy Director here at 11FS, and I'm joined this week on Fintech Insider News by my co-host, Kate Moody, Strategy Director at 11FS. Kate, can you believe we're now on 800 episodes?
I mean, I trust the ability of the team to keep track. And there's kind of like a good public record of them. So I can believe it, but it does make me feel very old. Because I checked like the number of the first podcast that I did, and it was number 371. I'm like, how can we have done that many podcasts since then? So clearly the team can keep track. I cannot keep track of time whatsoever.
Wow, yeah, it's a huge number. And with us today are some great guests who are here to break down this week's biggest stories in fintech and financial services. Firstly, a Fintech Insider welcome to Mariela Hunter, fractional COO in the VC industry. Mariela, it's great to have you here. Please tell us a little bit more about yourself and what you do.
Sure. Well, first of all, I'm a big fan of the pod. I'm excited to be here during this 800 episode milestone. You have created this fintech time machine. It's amazing. And speaking of time, I have over 10 years experience in financial services across the UK and the US, M&A, strategy, payments, corporate ventures, and corporate venture capital. And I'm focusing on the latter right now as a fractional CEO with a portfolio of 12 VC-backed companies. And I'm very excited to dive in today.
Awesome. Great to have you here. And we're also delighted to have Mark Mullen, CEO of Atom Bank. Thanks for joining us, Mark. For those of you who don't know, tell us a bit about who you are and what you do.
Of course. So it's lovely to join you. And Kate, you're not old. I'm old. I think I started out when there was still crystal sets. So I've been, this is my 35th year in banking and financial services. I'm one of the co-founders and the chief executive of Atom Bank. And before that, I had worked for most of my career in various different bits and bobs of Midland Bank Group, and then, of course, HSBC Group, both in the UK and abroad.
Amazing. It's great to have you here. And first off, we're going to talk about a news headline that comes from Fintech Futures. US bank-owned early warning to launch digital wallet Paze next year in an attempt to fend off big tech. Early warning is jointly owned by 7 of the largest banks in the US, including Bank of America, Wells Fargo, and JP Morgan Chase. Digital wallet Paze has been designed to improve the payment experience in a bid to stave off competition from big tech companies. Due to launch next year, Paze will seamlessly integrate customers' accounts from participating banks into their wallet on sign-up, making the process feel easier and more seamless than others. Additionally, Paze will use network tokens instead of storing actual card details. Paze is in its first phase of rollout and currently testing with tens of thousands of its owner bank's employees. A full launch is scheduled for Q1 next year. We managed to catch up with James Anderson, the managing director at Paze, who explained a little more about it.
So Paze is a brand new way to check out online, brought to consumers by banks and credit unions. Obviously, consumers work with their banks and their credit unions to solve financial problems and address their financial future. And we're excited to launch Paze to make it easier for them to check out online in a way that's more secure, more delightful, reduce the friction, and just make people's lives just a little bit better. It's a multi-bank wallet, so all the participating financial institutions share data with us at early warning, and all those cards, credit or debit, all those cards that consumers use to shop online are added to Paze, and your bank or credit union introduces you to Paze, gives you the opportunity to claim it, and then you use it online at participating merchants to check out easier and more secure. It only uses network tokens, so we're not dealing with real card numbers, and we make every transaction unique with what's called a cryptogram. So we're going to be launching next year, and we'll be excited to come back on the show and talk about it when it's live.
Wow, fascinating. So we have a new digital wallet launching in the US, and it's launching into what I think is an extremely competitive landscape. Mariela, I'm going to come to you first. How do you think Paze can stand out as a digital wallet of choice in the crowded market?
Yeah, it's a tough question. I would say, in addition to the experience, this is a twofold battleground, because you do have the experience with big tech encroaching between the banks and the customer. But the other big driver for this is the fees. So let me touch on the fees first, if I may. And we know digital wallet usage is increasing, with 60% online, over 40% in store, according to S&P Global Market Intelligence. But if you look at the total payment flows at the end of 2022, you had cards still at 70%, PayPal 17%, that's 17, and then Apple Pay was 7%. iPhones now have 65% of smartphone share sales in the US, but Apple Pay activation is close to 80%. So, of course, let's turn to attention then to Apple. And the Apple Pay experience is designed with the end user and the merchants in mind, making it easy and safe to pay for anything. And it has made the excuse, "I forgot my wallet," obsolete, right? The business model is not to charge consumers or merchants, so that logically leaves one party in the transaction absorbing the fees, and that is banks. Banks pay Apple 15 basis points of each credit card purchase. This is a separate fee on debit card transactions. These fees account for most of the Apple revenue for digital wallets, but it's only about 1% of total Apple revenues, which is around 782 million, which doesn't sound like a lot. But what is important is that it's doubling. It doubled from 2020 to 2022. So that's what banks are really battling against here. But if you just look at the interchange fees, that's a little bit one-dimensional, because when you scope the thread of the bank strictly like by looking at those fees, you don't think about consumers and merchants getting used to interactions with Apple, not just on payments. It doesn't seem far-fetched to have other financial needs solved. We know Apple, PayPal offer credit cards, buy now, pay later. PayPal offers many other value-adding services to merchants and developers, from small businesses to enterprises. So with Apple Card offering this, they're also not only getting the additional fee from banks, but they're now expanding into lending, competing directly against banks. So that's on the fee side. But turning back to the experience, banks are, I think, underestimating the power of inertia, because digital wallets are already used at the POS. They're already using Apple, PayPal, other brands at the checkout online. And now we're adding an additional option of the Paze icon next to the other options. And this is a new brand. Even though banks are already advertising it in their explainer websites, it's nonetheless still a new brand that a lot of consumers and merchants may not be aware of. And it is offering, in terms of the customer experience, ease. You only have to enter your email. You don't have to enter any other details. And you don't have to download another app. So it's making it easier in that way. But in terms of differentiation, and if I'm a bank thinking about protecting the customer experience, I'm not sure if, for instance, Bank of America, if that customer is going to resonate with my brand, if they now see the Pace brand as opposed to Bank of America brand. So how much better is it to have a new brand versus just continuing to use Apple or PayPal and then still think, well, I'm still using my Bank of America card?
Yeah, it sounds like there's a lot of complexity in how they might, land the proposition with customers. But I think your point about fees is very interesting. The incentives seem to be really clear. The banks are hemorrhaging fees for other digital wallet providers. In some ways, it almost makes sense to make their own. But trying to carve out that use in a complicated checkout page is difficult. Mark, I'm going to come to you here as CEO of a bank. It'd be great to hear what your perspective is on the fees that banks pay and where digital wallets are going.
Well, as I understand it, there's a class action underway in the States against Apple, and specifically a number of legal cases that they're fighting, and lots of them are really in the area of antitrust, where to me this seems defensive. And it's almost as though you're fighting a battle that's already been fought and lost. And it was fought and lost before you even realized that it was possible. And that's ultimately when a customer went and bought an iPhone or bought an Android device and ultimately installed into their life a vehicle for all sorts of things to be integrated in the software and the actual hardware devices themselves. And so the minute that happened, and I was there, frankly, back in 2007 when that journey began, I think banks were aware of the possibility of disintermediation, but not necessarily clear about exactly what form it would take. And it's becoming clearer and clearer that they are being attacked in a way that you might describe as death by 1,000 cuts. And that's because their business models are basically universal, right? So they want as much of the customer's wallet as they can possibly get, and ownership of the customer, which is a language I absolutely detest, because you really don't own a customer, nor should you ever. But ownership of the customer is one of the things that has sat at the heart of their business models for generations. And it doesn't work in a digital ecosystem in the same way. So to me, listen, I'm all for competition. This is competition, but it seems to me a little bit last-ditch defensive competition when the proverbial horse is already bolted.
Which seems especially ironic, right? Given the name of the holding company is Early Warning. I was trying to get my head around precisely what this is, and it took me about 15 minutes just to get past the initial search results for sort of geological disaster warning systems and things like that. So it's quite difficult to find out about it, and two, it doesn't necessarily seem the best branding for, as you say, Mark, something which is very reactive. I suppose the one thing that I kind of look at in this, and I think it could be positive, is if this does create options for credit unions in the US. We've talked a lot on the show about how important these institutions are in the wider US system. They serve proportions of the US customer base that the big banks just aren't really willing to touch or interested in touching. And we know how much they are struggling to compete in this ever increasingly digital world. They don't have the budgets and the kind of the resources to build these technologies from scratch. So I guess my hope, if we're trying to put a positive spin on this, is that maybe a platform like this could allow some of these credit unions to kind of come into this space and, as you say, not to own the customer mark, but to kind of take the relationships that they've earned from those customers and, give them a better chance of continuing to be relevant in this world that's increasingly dominated by online transactions.
I guess following that thread, that would be widening maybe the base of banks that are involved in this to all sorts of financial institutions that could benefit from it. Mark, are you seeing anything like this happening in the UK from the digital wallet market?
Not specifically, and I can't honestly claim that it's a particular area of expertise. I mean, the general observation I would make about this, as I would make about lots of what might be described as fintech innovations and initiatives, is that they tend not to try to attack all of the banking model. They tend to focus on different bits of the value chain or different bits of the banking model. And so it's almost like a multiple piecemeal attack. What's interesting about this particular response is that it's an attempt to aggregate across a variety of different types of financial institution and indeed some pretty big brands. Which is in and of itself, I guess a recognition of the scale of the threat. To Mariela's point, when you look at revenues doubling, and then you look at the sort of share of wallet potential that creates, then it explains itself. But this, in common with other responses, to me just feels late. It feels late and hopeless. Which is not to say that I'm a great sort of, advocate of monopolies, because let's face it, they tend to end quite badly when it comes to consumers. But nonetheless, it seems just a little bit of a tardy response to, something that's already achieved scale adoption.
Mark, you said that we've seen this from the consumer perspective, and it was Chase Pay a couple of years ago, and it had to fold because of lack of adoption. So it's a little bit of deja vu. But the interesting thing, if I was still in one of the US banks, and to your comment, Kate, around credit unions participating in something like this, firstly, I would be interested in getting customer surveys from retail customers and from merchants in terms of the likely adoption. But the main thing I would do is look at the unit economics of using Paze across card present, not present. What does it do to the interchange fees? But remember, this is not just about that. You think, as a bank, you think about supporting and implementing Paze back office. You have one more variable to operate. You have to monitor for risk, audit, set up data infrastructure. So I have not done this calculation, but to any other bank who has done this, my question is, how big is the delta, right, to the current options? And is it worth the time and effort? Because these types of initiatives in banks, on top of everything that is happening in terms of change and transformation, is not small. So is it worth the effort? It seems the strategy is to dislodge the consumer from something they already use without any effort. And we still don't know if that dislodging is likely to happen. So it's potentially big stakes on the economic side, operational side, but the payout is not that certain.
And it sounds extremely expensive. Right, brilliant. And on to the next article for today. And this one comes from AltFi. Atom Bank raises £100 million in equity funding. The digital bank announced on November the 1st that it had raised £100 million in equity funding from its existing investors. Atom has said the additional funding will be used to accelerate lending and balance sheet growth. The news of the funding means an IPO may be longer off than previously thought. Atom was founded in 2014 as the UK's first app-based bank, and in its most recent annual report, they boasted 224,000 customers, £6.6 billion in savings, and £3.4 billion of loans. Mark, well, we can hear it from the horse's mouth, can't we? And it's only fair to come to you first. Tell us more. What's the plan with this £100 million? And big congratulations.
Well, thank you very much. The plan couldn't really be any simpler because ultimately we're a regulated bank. When we lend, we have to set aside parts of that, substantial amounts of capital in buffers, and the primary use of this capital, therefore, is to support the growth in the balance sheet, growth in lending. And to that extent, there's no great mystery about what we intend to do with it. So, we started to turn a profit last year, and we expect, we've already seen that accelerate substantially this year. And so mystery solved. This is about growth.
Brilliant. Thank you. I mean, you guys are definitely moving in the right direction, but it has taken a long time to get here. And I think the amazing story about Atom is the transformation from a loss-making challenger into a profitable bank. I mean, the Altfi, the same organization, same publisher in 2019, published a post that was very, very different, saying, what went wrong with Atom Bank? I'd love to hear more about your story, about the turnaround. It's incredible.
It's interesting that you consider it to be a turnaround, or that Altfi thought that it went wrong. I've lived quite a lot of my life in sort of marketing, and therefore with a degree of public gaze. And one of my old bosses once advised me not to bark at passing cars. Because if you do my job, trust me, there's a lot of passing cars that you can bark at, and nothing went wrong. It just took a long time for us to build momentum, to raise the capital, and to weather some of the challenges that we, and frankly everyone else in the UK and around the world, has had to enjoy, quote unquote, over the last sort of 5 or 6 years. When we started the journey, we didn't expect one of our cornerstone investors to fold, and we didn't expect Brexit to happen the day we got the restrictions on our banking license. The Brexit vote was confirmed, and we didn't expect the impact of ring fencing, of QE. We didn't expect a global pandemic. We didn't expect a cost of living crisis, and we didn't expect, the latest whatever, plague of locusts or a plague of frogs or whatever will come next. And in spite of it, actually, we've managed to stay focused. We've managed to keep our discipline. We've managed to ultimately push the business model to a point where it's now generating some leverage and generating some momentum. And it's the nature of balance sheets. It's a balance sheet based business. They're quite difficult to generate sufficient scale and momentum with, but once you have it, actually they have more self-perpetuation. It doesn't mean to say we're done. And it doesn't mean to say that lots of things can't get in our way, even now, because they can. And so there's no reason for us to sort of be complacent or, think that the hard work is over. It's certainly not. Turns out it's really quite difficult to build banks, especially organically, and it's really quite expensive. But if you look at the sort of story of challenger banks in the time that I've been working, which is basically the tail end in 1989, most of the challenger banks that were born in that 34-year period don't exist today for a whole variety of reasons. And most of the ones that were created by sugar daddies, by which I mean they were created by big banks. And even they don't exist today. So the fact that we've managed to get this far and have the reputation that we have with customers and employees and be profitable and still have the faith and support of our investors gives me some confidence that maybe we're doing something right.
It really is an incredible story. And as you grow, some of those growth opportunities and challenges, I think, look a lot different to incumbent banks. For example, you don't have a physical branch network. Yet on the flip side, the UX expectations and the technology that you have to maintain is definitely not cheap, right? And neobanks in general, or challenger banks in general, I feel face similar challenges. Kate, I'm going to come to you on this. How do you feel about the kind of challenges and growth potential for the neobank landscape in the UK? Do you think they can keep growing?
Yeah, I mean, I think precisely the scenario that Mark set out is unsurprisingly absolutely right. Like, this isn't an easy environment to build a successful, flourishing digital bank in. I've always, I think, been quite open on my podcast, not just saying this because you're here, Mark, but I think I've always been quite complimentary about Atom. I've spoken with many of your team kind of firsthand. I know the kind of the approaches that you've taken over the time, to get to where you are. I think a large part of that comes from some quite pragmatic decisions that you've made about how you do what you do. You've chosen to stay in your area, stay in your swim lanes, in the sense of stay in the areas where you have strength, where you have the ability to really compete. You've built a really interesting environment, I think, in your office where all of your teams are kind of co-located. I was amazed, when I've visited the Durham office once or twice, you can stroll between, from a design team straight into a customer contact center in, a very short stretch of time. I think that kind of connectedness, I think, allows your team to make some really interesting decisions. And I think, it's a really interesting pool of talent that you have. You're not located in the London hub. You probably have challenges that come with that, but you're probably also able to build and retain a really kind of loyal and committed body of staff as a result of that. So no, I think there are definitely challenges, but I'm unsurprised that you guys have got to where you are. I suppose I'm really intrigued. You've always talked very persuasively, I suppose, Mark, about like your bigger ambitions for like the macro change that you want to see in the financial services industry, you kind of the wider disruption you want to see to some of those commercial models, to those relationships between banks and their customers. Obviously, this money is primarily to support balance sheet growth, but I'd love to kind of get a sense of where the ceiling is about aspiration. Do you want to launch new products? Do you want to kind of broaden out your offering, or is it just kind of continuing to build in the products that you've executed really well to date?
That's a very fair question. So I take some inspiration from the fact that the world's biggest companies started at ground zero like we did. It's very easy to persuade yourself that it's impossible to grow a really dramatically scaled business. It's clearly not. It's very difficult to do it. So let's just give people credit who've gone on that journey. But the world's great businesses, the world's biggest companies, started, from nothing. When we therefore look at growth potential of this company, even just looking at the UK, right, we're a tiny bank relative to the scale of the UK banking sector. We've had, give or take, £7 billion in deposits. Well, it's a big number in anyone's language, but there's £1 trillion worth of deposits sitting on instant access savings accounts alone in the UK. So therefore the growth potential of the company is immense. That isn't to say that you can just go out and buy assets or buy deposits. You've obviously got to grow profitably and sustainably, and you've got to be able to underwrite credit risks effectively. You've got to be able to manage maturity transformation. It's complex and risky business. Let's be really honest about it. But I don't see a ceiling to the growth potential of the company today, any more nor less than I did 10 years ago when we started to plan this project. I really don't. With regard to products and what we do and what we don't do things that people won't pay for. Who knew? Right, so we don't offer current accounts and transactional banking because people don't want to pay for them. And that's different from you can't make money from them. You can make money opaquely from them, but you can't make money transparently from them. Let's be really blunt about it. In much the same way that Mariela was talking about card interchange and card fees, the customer is paying for it. It's this myth that the customer isn't paying for it, which is just rubbish. The customer is paying for everything in the end. So we choose products and services that people actually get paid to have, like savings, or pay for, like loans. And it turns out it takes an awfully long time to be good at anything. And I would argue that the tier 1 and tier 2 universal banks are average at everything. And that's their vulnerability. So why would I build a bank that was average at everything? We have a long way to go to achieve the level of excellence in mortgage lending and in savings and in commercial lending that I want for our company. An awfully long way to go. And if it takes us another 10 years and I'm given permission to go on that journey, great. But in the greater scheme of things, it's still a microscopically short period of time when you compare how old we are with the 250 years of trading that Lloyds Banking Group have behind them. So they have a bit of a head start.
Excellent. And listen, Atom is a UK-based bank. And Mariela, I thought it might be interesting to ask you what you see from an international perspective or in the US. Challenger banks hitting profitability and growth. What does it look like there?
Yeah, this is, well, first of all, Mark and team, huge congratulations on securing the funding. I think this is a remarkable achievement in the current environment, but is a testament of the focus of the team, strong operational capability, but most importantly, the shift has gone from growth at all costs to back to fundamentals, back to profitability. That's what Atom has achieved. So, not as far as I know, Mark, no major acquisitions. And I think it's a little bit the other way around in terms of have you done major acquisitions?
Not at all.
Right. So it's having a strong plan, focus, and the vision, and these things take time, as Mark was alluding to. It's not quite the same in terms of other banks that have been fueled by this mantra of growth at all costs, which does come with acquisitions, taking a number of risks. But there isn't that sense of discipline and operational excellence that we're seeing from other more mature banks, which in turn means that back in the days of the year 2021, when we had these huge funding rounds, now some of these banks are running out of cash and they're having to come back to raise. But it's no longer about growth at all costs. The metrics are not there. And the environment has changed from near zero rates to higher for longer. And so they're finding it very difficult to raise in the current environment. And this is why you're seeing an increased number of banks either folding, there's capitulation, or there's just racing at down rounds. It's a very challenging environment at the moment. I would say the biggest challenge is this sort of sea of sameness, as Mark alluded to. A lot of the customer experience and propositions, when you look at the strategies of the neobanks, they're increasingly becoming diluted. So I remember when Chime launched, it was all about the early pay. Can you name a bank that doesn't offer early pay today in the US? And convenience. I mean, all of these different strategic pillars are now present in almost every single proposition. So you have the fundamentals on the financial side. And then on the products, what is truly innovative or what's going to create that sort of edge interest from consumers or businesses to gravitate to some of those challenger banks. And on top of that, you have the increasingly challenging regulation, as we know in the US. Getting banking charters is increasingly difficult. And quite a few banks have tried it and continue to partner with other banks. So it's a lot more challenging in that aspect. But I think this that contrast is hopefully helpful in terms of bringing the Atom story to life more in terms of its achievement in the current context.
And on that note, we're just going to take a quick pause here. Back shortly, everyone.
Hello, it's Benjamin here, Director of Research and Strategy at 11FS. Earlier this year, we published Building the Future of Home Buying, a report that calls out financial services for making the biggest, most significant purchase of most people's lives way more difficult than it needs to be. Well, fast forward to today and things haven't changed. Mortgage offerings are more important now than they have ever been, with sky-high interest rates in many countries forcing home buyers to shop around. We've got clients asking us how to move quickly to fix the problem and get a game-changing product to market. Want to know the secret? Step 1, download the report at 11fs.com/homebuying. Step 2, get in touch at 11fs.com/ventures. Speak soon.
Welcome back. Before we get back into the second half of the news, a note to go check out our most recent Fintech Insider Insight show. 11FS CEO David Embrer spoke to some great guests from Stash, Cedars, and General Catalyst to discuss the reported downturn in VC funding, which we've been discussing today. They discuss if the downturn is something to worry about, how this could impact fintech specifically, and those companies who are still managing to buck the trend and find investment. So go check out that episode in our podcast feed. It's the one just below this. Right, let's get back to the news. And next up, we have this one from Reuters. Deutsche Bank plans to close half of all Postbank branches by 2026. The German bank announced last week that changing demand from customers has driven their decision to close nearly half of all Postbank branches by 2026. Deutsche acquired Postbank in 2008, right in the midst of the financial crisis, and has turned it into their retail banking arm. Postbank was akin to the UK's post office, essentially. Its close connection with the German mail network meant it could offer postal as well as banking services. However, regulators were recently appointed to oversee Deutsche Bank's lending arm after several customer issues were identified following the integration of the Postbank arm. The move to close the branches is in line with their medium-term aim of transforming Postbank into a mobile-first FS provider. Postal and parcel services will continue in approximately 200 locations, the bank has claimed. So this sounds quite similar in some ways to the journey we've been on in the UK. Kate, does this validate some of these trends? They're just not sustainable, these branches?
Yeah, I mean, I'm not sure we needed to kind of validate it per se. I'm sure the vast majority of people listening to this show know either kind of through their time in industry or through their first-hand struggles in these big incumbent organizations, how hard it is to take a large physical network and to continue to make that make financial sense in the world that we're currently in. I did actually, I mean, full confession, as I attempted to research this in more detail, I did go down a deep historical rabbit warren of the history of the history of the German postal service, which I got very excited about. But I think it's, it was an interesting theory that, you could take a post network and a financial network and kind of find synergies in that. But really, they're seeing the same challenges that I'm sure lots of traditional bank branch-based banks are struggling with at the moment.
Yeah, absolutely. I mean, in the UK, we've had this big march away from branches, which we're seeing here as well. And also the Royal Mail has been on its own march away from providing, postal services and merging them in with shops. But it's kind of interesting that over the course of the last few years, definitely, there's been almost like a reaffirming of needing branches by some banks. So Nationwide is a fantastic example of that. They've just renewed their branch promise as a part of their new branding exercise. And Metro Bank, their new Colombian majority shareholder, they've also just reiterated their faith in the branch model. So you contrast that with the fact that 1 in 8 branches are actually closing. It's like, well, what is the right kind of model here? And I think, Mark, it'd be great to get your thoughts on this as a digital-centric bank. What do you think about branches?
Well, I haven't worked in a branch-based banking model for goodness knows how long. So my first experience of abandoning branches was First Direct back in 2007. I was a CMO for a few years. And I there was a maxim that I used to try to live by, which is that it seemed to me that the less time you spent in front of your customers, the more satisfied they were. And it's true, right? That if you give the customer the tools to do it themselves, then they're more invested, they're more in control, they're more empowered, and they're more satisfied. It was never a trick that First Direct's customer satisfaction was much better than its parents, or frankly, most of the businesses. It was a model that ultimately appealed to financially self-directed, literate, and control-oriented customers. And that's still true of digital banking to this day. Therefore, the big question is not about whether it's a superior model for millions and millions of customers, because it certainly is. The bigger question is, what do you do about people who are not digitally native, who are not technologically confident and conversant, who are not financially literate or conversant? And how are you managing or supporting them from, a transitional state? Because again, the universal banks have customers from 9 to 90. Whereas the digital first models have customers who only joined them digitally and technologically. So you haven't taken it away, right? And when you're taking stuff away, that's a much bigger problem in terms of, what it means for customers. So I'm not a fan of branch banking, but that's not quite the same as dismissing the importance of multi-channel banking to a much broader sort of, if you like, range of customers.
It feels like the model is yet to fully work itself out in some of these areas. Mariela, from an acquisitions point of view, it seems a little bit weird in some ways. Did Deutsche even really need to acquire Postbank? I wonder what the investment thesis was there. Was it just buying the customer base, for example, and retail banking infrastructure? Why would it do that?
I don't know is the short answer in terms of the logic of the acquisition. But if it was on the basis of the consumer and the branch, I think it makes more sense when you think about the German market and some of the differences perhaps with the UK, because firstly, this story does bring a little bit of nostalgia. My first bank account was with Deutsche Bank, and when I was a student, and the branch was in this beautiful marketplace. And when I was a student, I did need an extra hand, so I did want to speak to somebody, and they were brilliant. But the difference here of the German market is they are one of the biggest cash users still today. I think they're around number 4 or 5 after Thailand, Japan, or Spain. The percentage of transactions that are cash in Germany is still around 39%. And when you think about Germans visiting a branch, this was just a few years ago, but it was around 70% of Germans visited a branch at least once per month. That seems quite high considering it was just a few months ago. Not like for like with the UK, but I recall seeing a survey showing that 22% visited a branch once every 6 months. So it makes more sense, I think, if I was a German bank to have that level of coverage when it's so important for the end consumer. But having said that, of course, these branches are not profitable. They couldn't just close them because of a long-term contract with Deutsche Post DHL. So they renegotiated the contract, and now they're executing the closures, leaving around 100 open. And they are experimenting with this sort of technical test. So what it says to me is basically they're going to keep those open to help those consumers that are not comfortable using mobile or online to migrate. But again, this is facilitating the migration. I don't think is to keep the branches per se in terms of that customer interaction. So it will be interesting to see how long does it take for this other 100 branches to also be phased out.
Absolutely. And let's not forget that a part of their strategy is to transform into a neobank, a mobile-first FS provider at some point in the future. So it'd be super interesting to see what kind of services they combine from a mail post office point of view, which they could possibly do. The German cash culture is really incredible. I mean, gosh, I remember the last time I was in Berlin, I tried to pay with contactless at a bar and they just stared at me. And it still remains the case, I think, is as you've just said. We actually asked LinkedIn, I think internationally for our international audience, when they last visited a branch. And those stats you said, they were very interesting. So internationally, we heard that 59% of respondents said over a year ago. So it's definitely not internationally most frequented, but there's the cultural nuances, I think, as you say.
My research radar definitely goes off when I hear those numbers, right? Like our audience will definitely skew towards that sort of more digitally engaged, right? So, I mean, still interesting, but I think Mark's point around not forgetting that there is an audience that isn't in this space and isn't looking kind of for necessarily digital-led offerings is really key. So yeah, I don't know. It's interesting. It feels like there's been a lot of chat around trying to move away from individual brand branches and trying to kind of treat this as more of a sort of community facility, kind of shared spaces where multiple banks can have a presence. Which to me, based on kind of the type, when you think about the jobs to be done that customers have when they do reach out or want that kind of human intervention, it doesn't necessarily feel like it needs to be a Lloyd's branch or an HSBC branch. It probably could be just somebody that can help you work through a financial problem, or can help you get access to the cash that you need, or can help you fill in an application form. But we've sort of seen that idea seemingly sort of drop out of the discussion a bit. I've not seen it kind of top of mind recently as much as I'd like to.
Yeah, and in some ways that was Royal Mail's model, I guess, with integrating with shops and letting them provide the service. Your point about, re-engineering branches, banks have been trying to do this for years. I remember in 2010, I was working on a new digital bank that had branches, but we weren't allowed to call them branches. They were called shops. And shops came with sofas and teas and coffees and, Diet Coke that you could have in the branch. And sure enough, I don't think that bank did very well over time, but it's definitely a pending question. Right, let's move on to the next article, and this one comes from Sky News. Railsr gets a £20 million second wind just months after insolvency proceedings. Embedded finance platform Railsr has raised £20 million from investors as it eyes expansion following a tough year. 7 months ago, the firm faced insolvency proceedings following regulatory and financial issues, which put a hard stop on its rapid growth. Railsr was then acquired by a shareholder consortium, and former MasterCard chief Rick Haythornthwaite was brought in to turn around the embattled company fortunes. Having stabilized itself and calmed the nerves of regulators, Haythornthwaite is now due to head up NatWest, and a new CEO, Philippe Morel, is due to take over, but not before the company announced its latest £20 million of funding as it sets its sights back on growth. Wow, I feel like Railsr has just been this roller coaster of ups and downs. It's like the fintech intrigue, really, over the last couple of years, hasn't it, Kate? Where do you think it all went wrong for Railsr?
I feel like I've lost track, in all honesty. I mean, I think, when you saw their CEO talk about it, he attributed it to being, going too big too soon, to kind of come back to the point Mark was making earlier about, how difficult it is to scale things, aggressively quickly. It feels like they themselves cited that as being the main thing that had unstuck them. I suppose I'm still a bit disappointed. We were talking on the show way back when they were first getting into trouble about who might come in and acquire them, and there was talk about Flutterwave, obviously a massive fintech on the African continent, them coming in and using kind of the Railsr infrastructure as a way of kind of accelerating their growth into Europe, which to me would have been really exciting and kind of really interesting to see. So I'm obviously pleased for them that they are finding their way back. I suppose I'm still just getting over my disappointment that the Flutterwave acquisition didn't go through, because I think that would have been really interesting to see how that supported their growth. But yeah, hopefully they can use this money to stabilize, and it'll be interesting to see what they do from there.
I agree. I mean, Flutterwave or another company like that would have been very interesting to provide all sorts of different embedded finance services. And I think the other thing about Railsr is that they do deserve credit for being one of the few early doors companies in banking as a service that really started the industry, or the sort of the modern sense of the industry as it is. And so, although they did grow too fast, too quick, they do deserve some credit for what is still just the opportunity of embedded finance, because I think it's an extremely competitive landscape. I think in a lot of ways the use cases are still untested, despite it being extremely exciting. Mariela, from your point of view, do you think another round of funding will help them? Do you think there is the market out there for Railsr to go and grab in Europe?
Yeah, I like to make a distinction here on Rails because of its history and the different funding rounds it's had, because there's two elements playing out here. There's indeed the broader VC capital markets backdrop playing out. And on that context, we're seeing some of the effects of 2021, the bubble working its way through the system. But this is an impact beyond fintech. Rails, it touches on what we discussed before, which is a growth at all cost story. So the highest round was the 70 million back in 2021, and that was at a valuation of 1 billion, which is not surprising given this second half of 2021. The companies that raised during that period, as we mentioned, have had to come back to markets and raise again. And, like the story we heard from Atom, this is a very different story. Back then in 2020, before that round, they had revenue of around 5 million. This was probably the peak of the fintech market at the time. Expenses were around 18 million. They had tried to make that acquisition at that time, and they were generating net losses of around 13 million. Then they went and got a credit line for 22 million. And then after that, there was Series C, I think it was Series C, of around 26 million. But that valuation was a fourth of the previous valuation. And 1 year later, during the sales process, there were around 248 strategic buyers contacted, and nobody wanted to bite. So it ended up selling to a consortium, as we spoke, for around 414,000 from that 1 billion valuation. And when you look at the balance sheet now, if I'm looking at the right data, I'm looking at assets around 2.5 million. But to answer your question, and why I'm very skeptical, is I'm looking at creditors of 35 million. So if I think back to the year of 2020, when they had the full fuel, rocket fuel behind them, and you have 35 million in debt, you're looking now at the market and their customers. Where's the revenue coming from? This is fintech selling to fintechs. Fair to say some of them might not be around. The second part, they were selling to crypto firms. No comments there. Selling to corporates. I think we can expect that from a corporate spending perspective, the innovation budgets in 2023 are not as rosy as they were in 2021. Now, these things will come back, no doubt. And I agree with you that there's plenty of room to grow in the embedded finance space after the correction. But my question is, even if Rails is expanding into Europe, which firms are best positioned to capture that growth, that are not encumbered by some of these issues that the team at Rails are focused on right now? So it's a very challenging environment. I think it's great that they raised this round, but it's hard to not look at this elephant in the room, the 35 million in debt that they have to address at the moment.
Absolutely. And also at the same time, they do see that growth. So Dan Adler of D Squared Capital, one of Rails's investors, said they were a market leader in the UK and present significant growth potential in Europe. So they're definitely looking to that. But as you say, it's not clear where they actually go, on top of the fact that there's a lot of regulatory pressure, I think, on BaaS providers in Europe and in the UK. I'm curious, Mark, to get your view about how you perceive the BaaS market and its growth as a bank. And do you see all of these banking as a service providers running around trying to set up banks themselves and get growth?
It's interesting. It's an interesting case study because it possibly illustrates one of the challenges of for all fintechs and frankly for all entrepreneurs or business startups, that the expertise and insight required to build the customer solution is one thing. The expertise required to run a disciplined company is completely different. And I think we've seen a few examples where people excel in one area, but they don't necessarily have the experience or the team or the skills to run all of the, frankly, workaday things you have to do just to make a company operate efficiently and effectively and keep control of the purse strings and et cetera, et cetera. I don't know whether that's the case here because, as we said, the market opportunity is certainly significant. 1 in 4 UK customers or consumers have, used embedded finance, and we can see that's probably going to grow. And so to me, this just looks like there's two interesting. One, did they know how to run a company as opposed to did they know how to create and market a piece of technology? And then the other interesting dimension is private company valuations. And what did they really mean as opposed to, fundamental business growth prospects and fundamental business valuations based on earnings multiples and based on track records and proof points. And this is something that, I've had quite a lot of engagement with, as you can imagine, over the years. And that's in a sector, let's be really honest, where valuations, if you're banks, are quite challenging, full stop. And valuations, if you're fintechs, pre-public, are very, very difficult to sort of have confidence in. So that to me is the most interesting part of this particular story. In regard to banking as a service, I'm a skeptic. I'm a skeptic because I've seen the sort of bank in a box model. It's been sold to me in a variety of different flavors over the years, and it's a myth. It's a myth. At least in my experience, it's a myth. Why do I say that? I say that the level of customization that even quite a modest bank requires in order to create an operating model that passes muster with stakeholders and regulators and its own team is really quite considerable. That having an Acme Bank white label proposition that you can just sort of replicate like peas, I don't buy. And the exportability of full banking models across borders is very, very difficult, as much as anything else, because there are significant and meaningful nuances in customer expectations from one country to another, even though they might be neighbors. And I learned that when I was in Dubai in the Middle East, which is very easy to say that people have a single language in a region, and that'll make them all the same. Oh, no, it won't. That'll mean that they have a shared characteristic. And therefore, having something that is truly adaptable across borders, technologically, it's a lot easier to describe than it is to implement.
100% agree with that. And yet still very exciting and lots of potential. It feels like the model hasn't really been proven yet, but Railsr has a roadmap ahead of them and the ability to do so. You also mentioned the Middle East, which I think is very interesting just to touch on. I mean, the Middle East is probably the biggest, I would say, growth area, shall we say, for fintech in the world at the moment, or should we say the Middle East and North Africa together. And that is a region that is extremely diverse and extremely different from one country to the other, with regulatory landscape that is very, very fractious. So it'll be interesting to watch over the next few years how banking as a service providers scale across the region there. All right. Thanks, everyone. Now on to the last segment of the podcast. And this is a segment we call Big Click Energy, a quick fire roundup of some of the more click-worthy news this week. Over to you, Kate.
Awesome. Yeah, I mean, very relevant given what we were just chatting about in terms of the Middle East. This one comes from FinExtra, and it is KFH rolls out Shari'a-compliant digital youth bank. KFH, Kuwait Finance House, have launched a new digital bank targeting the youth markets. New online bank TAM offers instant mobile onboarding and supports customers with student finances. There is also a built-in rewards program offering points and cashback with participating retailers. October has been a busy month for KFH, who also launched a digital payment platform for SMEs. I mean, firstly, I'm just super impressed by rolling out a retail offering and an SME offering in such quick succession. You kind of hope that they've not bitten off more than they can chew. But I suppose the point we were just making about this being a region of huge growth, but also huge diversity, just really pleased to see that we're starting to see some of these smaller markets. Kuwait has a population of just over 4 million, but we're starting to see some of these propositions come into market. And I think maybe there might have been an assumption that stuff which was starting out in Dubai or the UAE more broadly was just going to seep across the region, just be the same proposition lifted and shifted. And actually what we're seeing is localized propositions coming to market. So it seems like a really interesting bundle of components to have rewards, points, cashback from day one. It'd be interesting to kind of see how they've structured that. But congratulations to the team on the launch, and looking forward to seeing how it fares in market.
Yeah, it's great news for the region. Right, next up, this comes from Finovate. Swiss retailer Coop partners with embedded finance firm Additiv to launch a super app, Coop Finance Plus. Coop is one of the biggest retailers and wholesalers in Switzerland, and it's making the move into financial services. The partnership with Additiv sees the launch of Coop Finance Plus, which initially offers banking services, payments, and pension solutions. Coop claim they are the first company in Switzerland to launch a fully online financial solution. Users will be able to open bank accounts and debit cards and invest in retirement programs. The app will entice customers with above average interest rates and loyalty rewards. Additiv believe the app will have a profound impact on the user experience of Coop customers. I mean, again, we've been talking about embedded finance, and for me, this is a classic example of maybe one of the more obvious, underserved use cases for embedded finance, which is partnering with big retailers. Big retailers have the customer base, they have access to behavioral data on, what products might be relevant to them. And so I think we're going to see a growth of retail partnerships with some form of banking service. And I think investments in retirement is a very interesting way to start. Because also, again, going back to the data, you're going to understand a lot about your customers. So maybe you can give more complex products that are more relevant to people quicker. So, yeah, I think it's a really interesting example.
Yep, and our last story in this section comes from the FinTech Times, and that is Innovate Finance introduced first Pride in FinTech Power List. The new industry spotlight created by Innovate Finance is designed to celebrate those from the LGBTQIA+ community who have made an outstanding contribution to FinTech. The list features contributions from some big players in the industry, including Airwallex, Monzo, Starling Bank, and Zopa, and is supported by Google. Lou Smith, chair of Innovate Finance, said, "We know more actions needed to boost levels of diversity and inclusion in the industry. This initiative will help spotlight the diverse voices already part of the FinTech story in the UK." Unsurprisingly, don't have much to add to this other than it seems like a fantastic initiative. We know how important it is to help people see themselves mirrored in the roles that they aspire to hold themselves. So anything which helps people from this community to have greater confidence to enter and then remain within financial services can only be a good thing. We know that we need those voices within financial services to improve what it is that we're delivering on as a whole, and make sure that we're creating financial services that are solving for the whole community, not just sort of majority groups.
Good and needed, isn't it? Right, now it's time for the and finally section of the show, a look at something more offbeat from the news this week, and I wonder whether you can guess what that is. With Halloween last week, that's right, Halloween, we asked our LinkedIn community, what fintech would you bring back from the dead? And I think we've got quite a few to choose from with the down rounds that have been going on in the last few years. So we wanted to find out from you, our listeners, which fintechs you miss and why, and you didn't fail to tell us. Tom Rennick, head of business lending at Atom Bank, called out Motif for their approach to thematic investing. Chantal Swainston mentioned Flux, if you remember those. And Lannister was the fintech of choice for Conrad Ford, who called it part fintech, part fable, and part soap opera. We should add that Jeremy Barber, CEO of Lannister, did respond to Conrad, as they are still very much alive and kicking. But there are still folks like Frankie Woodhead, who professed his love for the physical debit card, though he also confessed he hasn't used one in a while. Our own CEO, David Breyer, nostalgically name-checked Midland Bank and their big blue chipboard. If you know, you know. And actually, I think Midland Bank headquarters in London are now the Ned, if I'm not mistaken, that incredible bar private members club situation, which is amazing. I love it. And a big thanks to everyone else who commented. You can still find that post and get involved on our LinkedIn page right now if you would like to bring a fintech back from the dead. But for our panel, I'd love to know from each of you, what are your thoughts? Who should we bring back from the dead? Do you agree with any of those suggestions? Kate, go for it.
Yeah, no, I definitely agreed with Chantal around Flux. I mean, I think they were doing something really cool. I think having the ability to see the detail beneath just the overall amount of a transaction is so critical, especially to customers, who are more financially constrained. We know that budgeting happens at the item level, not just, I spent 50 quid at Sainsbury's, but, actually, how do I reduce what I spend on cleaning products or, bread or et cetera, et cetera. So I think the work they were doing to try and create that infrastructure to allow customers to have an extra level of insight into their money was super interesting and could have been really, really beneficial to customers. So yeah, really, really sad that they've not made it. And still kind of hoping that somebody maybe will swoop in and bring it back from the dead, or maybe incorporate it into their own offering.
Maybe resurrect from the dead, perhaps? That was my lame attempt at a Halloween joke. Mariela, you next. What do you think?
Yeah, I don't think any ghosts here, because the fintechs that have most impacted me have been in the cross-border payments and FX, and luckily they're still well and alive. So not much there. Perhaps the one that comes to mind, but I'm not sure, because Cabbage was an acquisition, right? So I think they're still very much kicking around under their acquirer. So that's probably the only one that came to mind.
I guess maybe that's the question, right? Has a company died once it's been acquired, or does it still exist? I guess maybe that's the nuance of the is it still alive? I don't know.
We need to set these rules for the next Halloween survey that we do. And Mark, over to you for the final word. Who should we resurrect, or maybe who are you surprised are still here?
Oh gosh, I'm surprised that there's a whole bunch of banks that are still here. But unfortunately, I'd end up being sued if I named them all. And I have a degree of nostalgia along with David Breyer about Midland, because I started my career in Midland and had I think a Vector account. They were one of the first sort of, if you like, let's brand and package bank accounts. They had a Vector account, I think an Orchard account, and then a Meridian account if you were super wealthy. And of course, we can thank Midland Bank for introducing free if in credit banking way back in 1985. So some things might be nice to revive, but some things should be killed off. I will leave it to your listeners to decide which is which.
Did the Orchard account come with apples, or was that just...
You would hope, but I don't even know what it came with, but I know it had its own sort of nice debit card, and it made you feel just like maybe you'd arrived somewhere. God only knows where.
It should have come with apples. Maybe that's what ended Midland Bank. The cost of shipping apples was just too much. And on that note, that wraps up this week's Fintech Insider. Thank you so much to today's guests. Where can people find out more about you? Mariela.
Yes, you can find me on LinkedIn, Mariela Hunter.
And Mark.
Yeah, you can find me on LinkedIn as well, Mark Mullen.
And Kate.
This is getting horribly repetitive, isn't it? I'm also on LinkedIn or Kate Moody, or you can drop me an email if you really want to, kate@learnfs.com.
Surprisingly, I am also on LinkedIn, and you can find me at David BG. And thank you so much for listening, everyone. You can join the conversation on social media or email podcasts@11fs.com. Thanks very much, and goodbye.